This is Nightly Business Report with Tyler Matheson and Susie Guerin. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Earnings kickoff. Alcoa starts the season with a beat. The CEO is with us to discuss his outlook, the slumping stock price, and what the Fed's next move could mean for his company.
Back to business. Congress rolls up its sleeves and gets to work. But will it be able to get anything done on student loans, immigration, the Farm Bill?
And less is more. Why 3 funds might be all it takes to keep your portfolio well diversified. We have all that and more tonight on Nightly Business Report for Monday, July 8th.
Good evening, everyone, and welcome back from the long weekend. We begin tonight with a history lesson. 81 years ago today, stocks hit rock bottom. On July 8, 1932, the Dow sat at 4122, not 4,122, 4122, a depression low on NYSE volume of just 720,000 shares. Today, stocks turned in their third winning session in a row. The Dow closed at 15,224. Share volume, 3.5 billion shares. There wasn't much news to propel stocks today, so investors seemingly conjured memories of Friday's superb jobs report and rosy visions of the earnings season to come. The Dow, off its high for the session, shot up 89 points. The Nasdaq added 5. The S&P 500 was up 8. The Russell 2000 index of smaller stocks closed at a record today of 1,009. As for that earnings season, Alcoa kicked it off today after the bell, and the numbers were pretty good. Excluding special items, the aluminum giant beat analyst estimates, and Alcoa made 7 cents a share. At edged forecasts by a penny, it saw a slight beat on revenue, too, even though sales were down a little bit compared with last year. Now, despite weak aluminum prices, Alcoa benefited from increased demand for its metals from auto and aircraft manufacturers.
So how do things look for the aluminum giant for the rest of the year? That was my first question to Alcoa CEO Klaus Kleinfeld when I talked with him a short while ago.
Well, we do see that there are bright lights in the world. I mean, if you want to talk about region, I mean, we see that the U.S. is continuing to grow. I think we're talking about a growth of 2%, probably accelerating even in the second half of the year. Bright spots in some areas like aerospace, automotive, and potentially building and construction, trucks and trailers doing better also than we thought before. So that's good. Europe is kind of muddling through. And China, I continue to be optimistic, probably something around 7.7% GDP growth. So that's kind of the world view. But despite those bright lights, Klaus, you have been forced to cut back on some of your capacity. You announced 2 plant closings in this latest quarter. Are we going to be hearing about more of those kinds of closings? Is there more to come? Well, we are faced with a pressure on the metal price in the upstream side, and therefore we're taking the respective steps and curtailing, restructuring, and closing plants. At the same time, we're also growing our value-add businesses. On the automotive side, this is now the second expansion that we're doing. The first one was in Davenport. The second one now is in Tennessee. And the orders basically are already there for this, even though the plants have yet fully opened. We are expanding on the aerospace side with 3 investments, one in Pittsburgh that we just finished, the second one we're doing in Kidsgreen in England, and the third one in Lafayette in Indiana. So there's a lot also going on the growth side. You know, Klaus, there's been a lot of talk, and I'm sure you've heard it, about the Federal Reserve cutting stimulus out of the economy. When that happens, will that help or hurt Alcoa's business? Well, look, I mean, that's a complicated one because I believe it will only happen, as Bernanke and other Fed presidents have said, if the recovery of the economy is stable and strong. A stable, strong recovery of the economy will help Alcoa on the upstream as well as on the downstream side. So in light of that, I think in the end it will be the right thing if done with the respective moderation and not leading to a disruption in the marketplace. Well, let me put it this way. Looking at business conditions under that scenario with the Federal Reserve moving out of the economy, will you feel comfortable
still about adding jobs? Because Alcoa has been adding jobs over the last year or two.
Well, we have been adding jobs in those businesses that grow, automotive, aerospace, even building and construction. But we also had to restructure on some other ends around the world. So we see this mixed picture there. But in the main, if you particularly look at the U.S., the recovery is clearly underway here.
I want to ask you a little bit about Alcoa stock. It has been a tough time for investors. They've seen the stock drop sharply, and it has been the worst performer in the Dow. I'm sure you don't like hearing that, but what do you think it's going to take? What's going to be the catalyst to get this stock to move higher?
Well, I believe that we have to concentrate on those things that we really can control to add value. And the things that we can control is we are growing our value add businesses, putting a lot of innovation in there. If you look at the year to date, the value add business already makes 57% of all of our revenues and accounts for 80% of the profitability of Alcoa. So it's a major driver of Alcoa, and it has a lot of growth prospects. These are all good things, and eventually, when we create this value, I think the shareholders will also recognize that.
And a little later in the program, we'll have more on what to expect this earnings season as we look at which sectors may surprise investors with strong growth and which are likely to disappoint.
Well, the FDIC is gearing up to announce higher capital restrictions on banks tomorrow, and some of the nation's biggest lenders are not happy. The stricter rules are believed to include raising a key leverage ratio for banks to 5% from the current 3% and will include off-balance sheet items and will not be adjusted for riskiness. The new requirements will be stricter than the international banking rules known as Basel III.
Just days after delaying some health insurance requirements for companies, the White House is now rolling back some more requirements for the new health care plan. The administration says it is now relaxing income verification and insurance status rules for people applying to state-backed insurance exchanges. They're slated to be in place on October 1st. Shares of some of the nation's largest health insurers hit 52-week highs today, including United Health Group, WellPoint, and Centene Corp.
White House staffers were busy this past holiday weekend, but members of Congress were off spending the week in their home districts. Now, though, they are back, and they've got a lot of major legislation to work on before their next break, which is just 4 weeks away. Hampton Pearson has more.
As Congress returns to work on Capitol Hill, July could be a make-or-break month for three key issues: immigration reform, student loans, and the fate of the 5-year Farm Bill. Fixing the student loan problem has the most real-world impact. Rates doubled on July 1st for the most popular student loans, just as an estimated 7 million college students began filling out applications for the fall. This afternoon, House Speaker John Boehner and Senate Majority Leader Harry Reid squared off again on student loans.
Listen, the House has done its job. And the fact is that it's students that are going to pay the price when they see the interest rate on their loans doubling.
The legislation passed by the House would balance the budget on the backs of struggling students.
House Republicans hold the keys to the fate of both immigration reform and the Farm Bill. On immigration, the Senate plan that couples the promise of a path to citizenship with increased border security is a non-starter with House conservatives, who favor a piecemeal approach.
The Speaker, John Boehner, is in a very weak position with his band of very extreme conservatives who have little interest in making concessions.
The fate of the 5-year, $500 billion Farm Bill is uncertain. House conservatives want deeper cuts in the almost $80 billion a year food stamp program, which, along with billions in farm subsidy programs, expires at the end of September.
A large part of that bill, and it's been estimated as much as 80%, may be allocated to funding food stamps. Republicans are saying, or some of the House is saying, that isn't going to benefit people in my district.
Look for political and economic fights over the federal budget and raising the debt limit to continue. The two deadlines that matter most, the August recess and the September 30th end of the fiscal year. And the clock is ticking. For Nightly Business Report, I'm Hampton Pearson in Washington.
Well, here's something lawmakers probably won't argue about. The federal budget deficit for the current fiscal year is shrinking. But before you start celebrating, the White House also said there's still a shortfall of $759 billion. Credit, though, goes to the improving economy and those across-the-board federal spending cuts in the sequester legislation.
Well, Uncle Sam may have been spending less money, but the rest of us did a lot more borrowing during the month of May. The Federal Reserve says Americans increased their debt that month at the fastest pace in a year, with total borrowing reaching a record $2.84 trillion. Now, credit card use saw its biggest gain in a year, while borrowing for new cars and student loans also saw big increases.
Well, no more special treatment for high-priced clients. That's the word from Thomson Reuters today. The financial information giant has agreed to end the practice of providing high-speed traders early access to its important consumer sentiment data. The company allowed those traders to get the information 2 seconds before it was distributed to other subscribers for an additional fee. Regulators said those 2 seconds can give those clients an unfair advantage. For more on this story, go to our website, nbr.com.
Corporate earnings season kicked off today and will kick into really high gear later this week and next. Expectations relatively muted, but right now the market doesn't seem to care very much. Here to talk about what to expect, John Butters, senior earnings analyst with FactSet. Mr. Butters, welcome. What is the overall rate of earnings growth that you expect for the second quarter, and why do the estimates seem to be coming down rather quickly?
Right. Well, right now we're expecting earnings growth of just 0.7% for the second quarter, and that's down from an expectation of 4.2% at the start of the quarter. One of the reasons we saw a sharp decline in expectations was the unusually high number of companies giving negative guidance. We saw 87 companies in the index give negative guidance for the quarter. That's a record high. We saw a lot of negative guidance from companies in the materials, technology, and industrial sectors. Those are the three sectors we saw the largest cuts. And as a result, the growth rate has come down to the 0.7% expectation as of today.
When you see those kinds of cuts in expectations in materials, which would be mining, natural resources, industrials, does that tell you that the overall global economy is slowing?
Well, I think there's some concerns there. You know, last quarter we saw a lot of companies give mixed commentary in terms of what they were seeing from emerging markets. We saw some companies such as McDonald's and Coca-Cola say that conditions were still weak in emerging markets. However, other companies such as General Electric and United Technologies saw strength in emerging markets. So I think that's really a key theme to watch this earnings season. How are companies performing in emerging markets this quarter?
You mentioned technology there. I think the earnings have slowed there, but it's largely attributable to one company, or a big hunk of it is one company, Apple.
Exactly. The expectations for the technologies for earnings to be down about 6.5%. However, Apple is the largest contributor to this decline, and this is an unusual situation for Apple. For many quarters, Apple was the largest contributor to earnings growth in the tech sector. But starting last quarter and continuing this quarter, Apple is now a detractor to earnings growth. The company is expecting a 21% decline in EPS. It's expecting sales to be down for both the iPad and iPhone. And if you exclude Apple, that 6.5% decline would be cut almost in half. We'd only have about a 3.4% decline. So again, Apple's responsible for a large portion of the decline we're expecting in the technology sector.
There are lots of ways, John, to play with numbers to boost your profits, but there are fewer ways to boost your numbers with respect to revenues. What do you expect on the sales front this quarter?
Yeah, if we look at revenue growth, it's almost even with earnings growth. We're expecting about 1% growth. However, most of the sectors are expecting growth, 8 out of the 10. A lot of the weakness is coming from the energy sector, which is expecting revenues to be down 9%. If we exclude energy, revenues would be up about 3% overall. So again, not great growth, but a little bit better than the 1% expectation we're seeing right now.
All right, give me some artful speculation here, John. If the numbers are so muted, so soggy, why the heck is the stock market moving up as well as it is?
Well, it could be a case that the market's already discounting the second quarter and looking ahead to the second half of 2013, where expectations for growth are projected to improve quite a bit. In the third quarter, analysts are looking for growth to improve to 7%, and in the fourth quarter, that's expected to jump up to 13%. So again, one of the themes to watch this quarter, and we talk about it quarter after quarter, but again, you want to watch the guidance that companies are giving for Q3 and for the second half of the year, because again, there are lofty expectations for earnings growth for the second half of the year, and it'll be important to watch what companies are saying. Are they affirming that growth, or are they starting to ratchet their numbers down?
John Butters, senior earnings analyst with FactSet. Thanks for being with us tonight.
Great. Thanks for having me.
And still on the program tonight, there are over 8,000 mutual funds and ETFs out there, but you may need to only have 3 to have a well-diversified portfolio. But first, let's take a look at some of the stocks that hit all-time highs today. Former Treasury Secretary Timothy Geithner is building a nice nest egg after years of public service. Like so many policymakers before him, he's hit the speaking circuit. The Financial Times reports that Geithner recently made $400,000 for just 3 speaking engagements, one at Deutsche Bank conference in June and at 2 private equity firms' annual meetings in April and May. Pretty good, Kyle.
Pretty nice work there, if you can get it. Shares of computer maker Dell rose 3% today, and with good reason. The advisory group Institutional Shareholder Services is recommending that Dell shareholders accept the $24.4 billion buyout offer from company founder Michael Dell and his backers, Silver Lake Partners. Dell's offer was countered by a competing offer from activist investor Carl Icahn that would keep part of that PC maker public. But accepting Dell's offer won't be easy. One of Dell's major shareholders, Pzena Investment Management, called Dell's bid unreasonable and says it exploits the company's weak share price for the personal benefit of the CEO. We shall see.
Turning now to our market focus, we begin with Intel. This is the stock that dragged down the Dow today. Evercore Partners marked Intel down to underperform and lowered its price target to $20 a share, citing, quote, unfavorable risk-reward at current levels. Investors sold Intel at double the usual volume, and the stock closed more than 3.5% lower at $23.18. Facebook was a winner as it expanded access to Graph Search. This is a tool to find nearly anything indexed on members' pages. Facebook also posted information for users on how to restrict Graph Search on their content. Facebook gained almost 1.5% to close at $24.71.
Priceline.com, the travel site, touched a new 13-year high as Morgan Stanley upgraded the stock to overweight with a new target, $1,010 a share. Morgan Stanley says Priceline has an improved competitive position. Investors seem to agree, driving the stock up almost 4% on more than usual volume. Priceline today, $888.63 at the close. MasterCard touched a new all-time high as KBW hiked the stock price targets of several diversified financials. KBW said credit quality appears to be on pace to outperform for the year, raising MasterCard to a $691 a share target price. The stock has gained more than 20% this year, but after a fizzy open today, MasterCard lost carbonation on the day. It closed at $589.29. That's down about 1%. And the Jones Group has reportedly hired Citigroup to explore a sale, boosting shares of the retail brand owner. In addition to Jones New York Clothing, it is home to Anne Klein, Nine West, and more than 24 other big retail brands. Shares of Jones gained more than 7.5% on 6 times the usual volume. It closed at $15.75.
When it comes to your portfolio these days, believe it or not, experts are saying it doesn't have to be complicated. All you need are 3 funds for a diversified portfolio. Here to talk about how you can do that is Anna Pryor. She's a reporter at Dow Jones News Service. You know, Anna, just 3, that seems to go against everything that we have been told about diversification. So tell us what the thinking is behind this new back to basics approach.
Well, the thinking is that basically there is such a thing as too many choices. And so the idea is to simplify, get people going back to basics, and to really then focus on, getting a handle on what investments they have. And you can get great diversification in a portfolio with just 3 funds. And it's also worth noting that if you have 20 or 30 or 100 funds, it doesn't necessarily mean you're diversified. If you own 100 of, large cap funds, you're not you're not diversified.
Some of your funds may overlap. Okay, so I'm dying to know, what are these 3 funds that will do the trick for me?
So for the average investor, what they're going to want to look for is exposure to the U.S. stock market, exposure to the international stock market, and then exposure to bonds. And so what a lot of people talk about as kind of three key ones would be, again, some large U.S. diversified equity fund, as well as an international one, and then a bond one. Vanguard funds get talked about a lot in this context. You can also kind of put together a similar portfolio using funds from iShares as well. So there's a lot of different things out there. But if you want to go with the classic 60% stocks, 40% bonds, you would do 40% U.S. stocks, 20% international stocks, and then 40% bonds.
40% bonds right now sounds so risky. How do you choose these funds, and how do you even know which bond funds or stock funds to go to?
So you want to look for, you want to look for something that is very well diversified, so something that is tracking a lot of different securities. You also want to look for things that are low cost. So again, Vanguard, iShares, Spider also has funds as well. There's a lot of different low-cost index funds and ETFs. That being said, for some people, maybe active management does make sense. So you're going to want to get with your advisor and talk about what kind of makes sense for you. And so much will depend on your time horizon and your risk tolerance.
So I assume the classic way to do this, Anna, would be a total index fund, total market index fund that covers all the stocks that are traded in the U.S., a smattering of all the stocks that are traded internationally, and a collection of all the bonds that are traded in the U.S. That would be the classic way to do it, right?
Exactly. That would be kind of the classic way. But, some people talk about, getting one fund that's, global stock market exposure. So it combines U.S. and international, and then breaking up the other two funds into, a U.S. bond fund and an international bond fund. Vanguard does also have an international bond fund, and there are others out there as well that track indexes. So again, trying to, how you kind of divide it up is up to you based off of, your objectives.
All right. Sounds like a lot of homework to do there, but of a different kind. Thank you so much, Anna. Anna Pryor, reporter at the Dow Jones Newswire.
She says three's the charm there. Coming up, after years of declining sales, the boating industry is making a comeback, but will it be smooth sailing ahead? First, so a look at how commodities, treasuries, and currencies fared today. Barnes & Noble says its CEO, William Lynch, has resigned effective immediately as part of a larger reorganization. The company has been struggling to gain market share in the tablet and e-reader market.
Italy's Fiat is looking to own a little bit more of Chrysler. It's offering $254 million to buy another 3.3% of Chrysler. Fiat already owns more than half of the U.S. automaker, with the remaining stake is held by a trust that pays medical bills for retired United Auto workers. But the sale won't go through until U.S. court settles a dispute over the price. Meanwhile, Fiat is in a hurry to fully merge the two companies so it can benefit from the booming U.S. car market.
And while Chrysler has motored back from bankruptcy and a federal bailout, the pleasure boating business has also seen a big turnaround. And if a rising tide does lift all boats, an improving economy appears to be lifting boat sales. Mary Thompson has our report.
This summer, it's estimated 88 million Americans will hit the water, many of them in new boats.
We actually are anticipating following this past year, which was up 10%, with a 5% growth this year. And hopefully if the weather gets a little bit better, it'll be a little bit higher.
Smaller boats leading a surge in sales, a surge the National Marine Manufacturers Association's Carl Blackwell credits to higher prices on land.
The primary reason for increased boat sales is people's home values have come back. As home values increase, boat sales are going to increase.
The engine of the boat industry, power boats less than 26 feet. Accounting for 82% of the market, sales rose over 11% last year. Sales of big boats or yachts improving, but at a slower 4.4% pace. MarineMax sells 30 to 65-foot boats for between $13,000 and $2.5 million. Northeast Regional President Matthew Barbera says sales are good, but not great. Financing is tougher for clients, and an anticipated bump in Northeast sales after Superstorm Sandy has yet to materialize.
People are still working on their boats, getting insurance checks, So I think that it hasn't hurt us, it hasn't helped us, but eventually it'll create a lot of business in the service department.
For Viking yachts, sales have steadily been increasing off the lows of 2010. Viking makes custom-made yachts like this 70-foot fishing boat. Their average price, $3 million. So what's behind their increase in sales? A better stock market. Viking COO Patrick Healy sees sales accelerating in 2014.
We have a 60% higher backlog today than we did 12 months ago. So that's the exciting thing. Our growth's going to come next year. Our big growth will come next year.
A forecast you could call a sailor's delight. For Nightly Business Report, I'm Mary Thompson in New Gretna, New Jersey.
And finally tonight, members of the clergy don't need a boat to get around Vatican City, but they might need a car, but just not a costly one. Pope Francis is urging priests and nuns to exercise austerity and avoid flashy or expensive cars, saying, quote, "A car is a necessary, but please choose a more humble one." And if you're wondering what the Pope gets around in, Tyler, it's a Ford Focus.
How do you like that?
That's humble.
That's a humble car, but a nice car. We want to hear from you. Tell us which stocks you'd like our Market Monitor guests to discuss this coming Friday. Log on to our website, nbr.com, to submit your question, and be sure, please, to include where you're from.
And that's Nightly Business Report for tonight. I'm Susie Garrett. Thanks so much for watching.
And I'm Tyler Mathisen. Thanks from me as well. Have a great evening, everybody. We'll see you here tomorrow night.
Nightly Business Report has been brought to you by
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Susie Garrett with the Nightly Business Report news brief. Metals giant Alcoa kicked off the new earnings season with a slight beat on earnings and revenue, thanks to big demand from auto and aircraft makers last quarter. Friday's better-than-expected June jobs report helped propel the markets higher today. The Dow rose nearly 89 points. The Nasdaq added 5. The S&P was up 8 points. Americans increased their borrowing at the fastest pace in a year during the month of May. Credit card use, new car loans, and more student loans were the big drivers. The White House is delaying income verification and insurance status rules for Obamacare applicants. And Warren Buffett donated another $2.5 billion of Berkshire Hathaway stock to 5 charities. Be sure to tune in to Nightly Business Report right here on your public television station.